Welcome to The Explainer. If you've ever dealt with a property sale, you know there's the price you agree on, and then there's the government's price. Today, we're going to dig into Section 78 of the Income Tax Act. It's the new version of the old Section 50C, and it has a huge say in how your capital gains are actually calculated. So here's our game plan. First, we'll look at why this rule even exists. Then we'll dive into the rule itself, what it is, and the super important exception. We'll walk through a case study to see it in action, talk about your rights, and then wrap it all up with the key takeaways. Okay, so let's start at the very beginning. To really get a handle on any law, you've got to ask, why is it even here? What's the problem that a provision like Section 78 is trying to solve? It really all boils down to a classic situation, just like this one. Imagine you sell a property, the deal is done for 2 crores. But when you go to register, the official stamp duty valuation is 2.3 crores. Suddenly, from the tax department's point of view, there's a 30 lakh rupee question mark. So which number do they use to tax you? That is the exact conflict that Section 78 is built to address. Look, the government's motive here is pretty straightforward. They want to stop tax evasion. Simple as that. For years, there was a huge issue with property sale prices being underreported just to pay less capital gains tax. This rule is the government's way of putting a stop to that by tying the taxable value to an official benchmark. So, now that we know the why, let's get into the how. How does the law actually fix this? Well, that's where the powerful deeming rule inside Section 78 comes into play. Now, for all you seasoned pros and students out there, it's really important to know that Section 78 isn't some brand new, out-of-the-blue concept. It's basically the direct successor to the old familiar Section 50C from the 1961 Act. The logic is the same, it's just got a new home. All right, this next term is absolutely critical. You have to understand stamp duty value. You might know it as the circle rate, the guidance value, or the Ruddy Reckoner rate. Whatever you call it, it's the minimum value set by the state government for property registration. This number is the foundation of the entire rule. And here it is, the heart of the whole provision. The law creates what's called a deeming fiction. It says that if the price on your sale agreement is lower than the stamp duty value, the tax department can legally ignore your price and instead deem the higher stamp duty value to be your actual sale price for tax purposes. This can, of course, directly increase your tax bill. But the law isn't a total sledgehammer. It does recognize that sometimes valuations can be a little bit off, right? So to account for small, genuine differences, it provides a very, very important buffer. We call it the safe harbor. And that buffer, that little bit of wiggle room, it all comes down to one magic number, 110%. This percentage is the key that unlocks the safe harbor. It decides everything. This is where it gets really interesting. Think of it like a switch. If the stamp duty value is, say, 108% of your sale price, you're good. You're in the safe zone. They'll accept your actual sale price. But the second that stamp duty value hits, let's say, 111%, bam, the switch flips. You're out of the safe harbor, and the entire higher stamp duty value becomes your new taxable sale price. It's a real cliff edge. Okay, enough theory. Let's crunch some numbers and see how this actually works in the real world. This is going to make the impact of that 110% rule crystal clear. Just look at this. In both scenarios, the property is sold for 1 crore. Now, in scenario A, the stamp duty value is 1.08 crores. That's less than the 1.10 crore safe harbor limit. So, no problem. The taxable value is your actual 1 crore. But look at scenario B. The stamp duty value is 1.15 crores. Because that crosses the 1.10 crore threshold, the entire 1.15 crores is now considered your sale price. That's a 15 lakh jump in taxable income just for crossing that one tiny line. Okay, so let's say you're stuck in scenario B, and you're thinking, wait a minute, this stamp duty value is way too high. My property isn't worth that much. The good news is you're not just stuck. The law gives you a formal way to fight back. So here's the process. First, you have to formally dispute the valuation with your assessing officer. If the AO agrees, they can refer your case to a departmental valuation officer, or VO. Now, the VO's report is critical. If the VO says the property is worth less than the stamp duty value, great, that lower value is used. But here's the best part. If the VO comes back with an even higher value, the law protects you. You stick with the original stamp duty value. It's a no-lose situation in that sense. So, to make sure you're always covered and ready for any questions, good compliance is just non-negotiable. Always have your registered sale deed handy, make sure you have clear proof of payment, like bank statements, and honestly, if you even think there might be a dispute, it's a smart move to get your own report from a registered valuer to back up your claim. At the end of the day, good documentation is your best friend here. All right, we have covered a lot, so let's just pull all of this together and boil it down to the most important points that you absolutely need to walk away with. So to recap, first, remember the deeming provision. The government can swap your sale price for theirs. Second, the 110% rule is your safe harbor. Stay inside it, and you're fine. Third, if you think the valuation is unfair, you have the right to challenge it and ask for a VO referral. Fourth, and this is so important, documentation is everything. And finally, remember, this whole discussion is specifically about capital assets. We're talking land, buildings, or both. And that really leaves us with a final question to chew on. While the law uses the stamp duty value as its big stick, its starting point, it also creates a path for you to argue for what's real, the fair market value. It's a great reminder that even a strict rule like this has mechanisms for fairness built into it. I really hope this explainer made Section 78 a lot less intimidating. If you found it helpful, please do us a huge favor and hit that like button, subscribe to the channel, and share it with anyone else who might need it. Thanks so much for watching. And just a quick final note, remember, this video is for educational purposes. Tax laws change and everyone's situation is unique, so please always consult with a qualified professional before making any decisions.